Before we get started, do me a quick favor. If keeping more of your retirement income and sending less to the IRS matters to you, make sure you hit the subscribe button below. And if you can, turn on the notifications, because today we're talking about one of the fastest growing retirement strategies, especially that's going around all of social media, and it has nothing to do with picking better investments. It's about how you take money out. Specifically, finding your tax smart withdrawal sweet spot. And if you're within 10 years of retirement or already retired, this could save you tens, even hundreds of thousands of dollars over your lifetime. Here's something most people don't realize. Most retirees don't lose money because of bad markets. They lose money because of bad timing and bad tax decisions. Retirement isn't about income. It's about after-tax income. And that's why the strategy is trending. So what is the tax smart withdrawal sweet spot? Let's define this simply. The tax smart withdrawal sweet spot is the income range where you generate cash flow you can rely on without pushing yourself into a higher tax bracket, without triggering unnecessary taxes on Social Security, and without setting yourself up for tax problems later. It's not about one magic number. It's a range, and it changes over time. But when it's done right, it can mean paying little to no federal tax on tens of thousands of dollars. You could lower your Medicare premiums and far more control over your retirement income. So why most retirees miss it? Most retirees, when they see retirement advice, it sounds like this: delay taxes as long as possible, or don't touch your IRA until you have to, or maybe they hear required minimum distributions will take care of themselves. That used to make sense. Today, it's a problem, because what actually happens is this: Social Security starts, your RMDs kick in, income stacks up, tax brackets jump, and suddenly you're paying far more tax than expected, not because you did anything wrong, but because withdrawals weren't coordinated. Now, there are the three levers of the strategy. This strategy works by coordinating three things. Number one, your pre-tax accounts. Number two, tax-free accounts. And number three, timing. So let's walk through each one. Lever one is the pre-tax versus tax-free. Most retirees have most of their money in pre-tax accounts, such as IRAs, 401ks, and 403bs. That means every dollar withdrawn is taxable and eventually mandatory. The sweet spot strategy doesn't avoid taxes forever. It controls when you pay them. Instead of waiting for required minimum distributions to force income later, this approach often uses intentional withdrawals earlier, or maybe some partial Roth conversions in lower brackets, and full use of the standard deduction. The goal is simple: don't let the IRS decide your income for you. Now, let me give you a quick example. John retires at age 65. He has about $1.2 million in his IRA. He delays Social Security until 70 and barely touches his IRA. Sounds responsible, right? Here's what happens at age 73. Required minimum distributions start, Social Security is already on, income spikes, his taxes jump, and Medicare premiums increase. John didn't mess up. He just didn't plan the gap years. Now let's talk about lever two, Social Security timing. Social Security is one of the most misunderstood parts of retirement. Here's the key point: up to 85% of your Social Security can become taxable. Not because Social Security itself is taxed, but because of what else you're withdrawing. Every dollar from your IRA can cause more of your benefit to be taxed. That's called the tax torpedo. The sweet spot strategy asks, when should Social Security start? How much income should we take before benefits begin? And how do we avoid stacking income sources? Sometimes that means delaying benefits. Sometimes it means taking income earlier. There is no one-size-fits-all answer, only coordinated ones. Now, lever three, the standard deduction. This might be the most overlooked piece. Every year, retirees get a standard deduction. That means a certain amount of income can be tax-free, but most people don't use it intentionally. They either take too little income and waste it, or take too much and spill into higher brackets. The sweet spot strategy asks, how much can we take this year and still pay little to no tax? And then builds income right up to that point, not past it. We want to make sure we hit that limit. Now, let me be clear. This is not about paying zero taxes forever. It's about paying taxes on your terms at lower rates over time without surprises. In retirement, predictability beats perfection. So why is this trending right now? Well, this strategy is exploding in popularity because retirees are realizing large IRAs create large tax problems. Tax rates are historically low, and income coordination creates control. This isn't market timing, it's planning. Now, let's clear up some myths that are out there. One is, I'll be in a lower tax bracket later, or required minimum distributions won't be that bad. Social Security isn't really taxed, and none of those are guaranteed. Retirement taxes are math problems, not opinions. So your sweet spot changes as you age. Early retirement, you use low brackets. Mid-retirement, balance your withdrawals. Later years, reduce your forced income. This isn't set it and forget it. It's a framework. This resonates most with people who are within 10 years of retirement or are already retired and that have IRAs or 401ks or accounts that have yet to be taxed. They want income they can count on and don't want to overpay in taxes. So what can you do now? Here are 3 simple steps. 1, list your income sources by tax type. Estimate your future required minimum distributions. And know your current tax bracket and standard deductions. That alone creates clarity. Now, retirement planning has changed. It's no longer about how big your portfolio is. It's about how efficiently you turn it into income you actually keep. That's the power of the Tax Smart Withdrawal Sweet Spot. Now, if this video helped you, do 3 things right now. 1, make sure to like this video. 2, subscribe for future breakdowns. And 3, make sure you comment below the word sweet spot because the difference between a stressful retirement and a confident one often comes down to how well you manage taxes. If you also need help with this, you can always click the link in the description below to set some time up with us, and we'll make sure to walk you through the different steps and explore if you should take any steps right now or not. Otherwise, I'll see you in the next video. Thanks for watching.